In what may be perceived as a major reversal in policy, the Fed has announced it's going to start unwinding one of its emergency lending facilities. Plus, we're going to look at something in the payroll reports that nobody can see. Nobody is looking at this, but today, you're going to see that. All that and more in today's macro show. I'm your host, Steven Van Metre, and thanks for joining me today. Let's get right into our headline story. What's going on? The Fed has said we're going to keep easing, we're going to keep doing QE, and then out of nowhere, they say we're going to start unwinding. Let me show you the press release from the Fed this week. So the Federal Reserve Board on Wednesday announced plans to begin winding down the portfolio of the secondary market corporate credit facility, a temporary, which in Fed words it generally means permanent. That's what the surprise is here. Emergency lending facility that closed December 31st, 2020. Now, let me point something out here that's really important about that December 31st date. Congress took this tool away from them. So some people believe, it's no big deal. The Feds are going to come back and they'll just do it again. They can't. Remember, part of the Trump stimulus said no more of this. That was the deal. So this is gone. Now let's continue on. The secondary market corporate credit facility proved vital. Well, that's debatable in restoring market functioning last year, supporting the availability of credit for large employers who arguably didn't need the money or they didn't need anybody supporting them because they had plenty of money. They had credit lines. They didn't need this, but the Fed did it anyways in bolstering employment through the COVID pandemic. Well, I'm not sure about the second part either. So the Fed says the portfolio sales will be gradual and orderly. They have not announced when it will start or what the schedule is. We'll presume that at the next FOMC meeting, we will most likely get that answer, and will aim to minimize the potential for any adverse impact on market functioning by taking into account daily liquidity and trading conditions for exchange-traded funds and corporate bonds. So that's what's going on. Now, is this a big deal? Now, you have to go back to when they did this. It was a big deal at the time. It was huge because it was like, hey, the Feds are buying bonds, corporate bonds, so you should go and dump all your corporate bonds and buy as many stocks as you could. But did the Fed really do that much? Well, let's go look at their balance sheet and see. Well, here it is, the weekly H.4.1 factors affecting reserve balances. And here you see I've highlighted net portfolio holdings of corporate credit facilities, LLC. About $26 billion. And you go, well, that's not a whole lot. Hence why at the time, the market made a big deal out of something that turned out not to really be a big deal. So a lot of people are saying, well, this is nothing. So they're going to unwind their balance sheet by $26 billion. Not a big deal. But could it be? Well, let's talk about that for a second because, this is one of those things where people say, well, it's only $26 billion. Look, the notion that size matters here isn't the issue. Everyone thinks, it's not big enough. It's size. It has to be bigger. And if it was bigger, it would matter. Size does not matter, my friends. What matters is liquidity. See, when the Fed does whatever their schedule is going to be, there are rumors that they will unwind this completely by the end of the year. So that's entirely possible. So you're looking at, $4 to $5 billion a month or thereabouts. It's not the size, it's the liquidity, because as long as the market has enough money sloshing around and there's enough people in the bond market, because remember, these are bonds, these are corporate bonds, as long as there's enough money in the corporate bond market for buyers to absorb this, right, not a big deal at all. But if there isn't a lot of buyers, or if liquidity conditions change, which we were talking about. In fact, if you missed yesterday's show on the Wyckoff method where we looked at TLT, well, what does falling interest rates mean? So when you think about, okay, when interest rates go down, do financial conditions ease or tighten? Yeah, they tighten. So we're seeing the bond market telling us that bond prices are going to go up. Interest rates are going to go down. Financial conditions are going to tighten up. And so when there isn't liquidity or buyers in the market, and you start selling into that, what happens to price? Well, that's really easy to figure out. It goes down. And if you're struggling, like, Steve, I'm not sure I understand that. Think about you're auctioning something that you own off, a car, a house, something, right? and nobody bids on it, and they're trying to auction it. All right, we're looking for bids by 100, 200, right? And nobody bids. What happens to the price? It goes down until you find a buyer. That's the issue here. It's not the size, it's the liquidity. And no, the Fed can't undo it. They can't go back. Now, maybe they could stop it if things get worse, but that doesn't mean that they can't hit some bids that might not have a lot of liquidity if things dry up during this unwind. So it might not be anything, but it could be the wrong thing at the wrong time, depend on how liquidity provisions go. Let's take a look at the economic data, some interesting things going on in here. And one of the big issues we're looking at in the data is this inflation story. Where is it? Is it going to continue? Is it going to be transitory like I think? What's going on? Well, how about South Korea? Major exporter, CPI, month over month, went from 0.2 to 0.1. That's disinflation. That is the opposite of the direction that everyone is saying things are going to go. So if a large exporter is seeing deflation in its consumer prices, guess what eventually is going to happen? They're going to become an exporter of disinflation. Let's move into Wednesday's data. How about retail sales out of Germany? 7.7% the month before, phenomenal. Market was expecting -2, and now you're seeing -5.5. Now, I'm not familiar with any of the stimulus programs going on in the Eurozone or in Germany specifically, but this is not a good sign when you see retail sales drop that much in 1 month. Doesn't negate the month before, but it certainly takes a big bite off of the March numbers. Let's continue on and see what else we've got going on here. How about producer prices in the Eurozone? Disinflated, went down from 1.1 to 1.0. Still a big number in terms of input prices going up, prices coming out of the factory being higher. But when you see things like German retail sales go down, what is that telling you? When you see producer prices on one hand rising and on the other hand you see consumer spending going down, what is it telling you? Consumers don't have enough money to absorb these prices. So what is the long-term effect of that? Could even be short-term effect. If consumers reject higher prices, what direction do prices go? A lot of down arrows today in this show, I guess. They go down. That's what happens when consumers reject higher prices. If you don't have enough expansion in the money supply to absorb higher prices, inflation can be disinflationary. You might have missed this thread on Twitter if you're not following Travis Kimmel, who I think was baiting me out with his post the other day to talk about this. He might have been. I don't know for sure. It just seemed like a call-out thread begging for my response. But you can have higher prices that lead to disinflation and deflation when there isn't a strong enough expansion of the money supply to support them. How about the mortgage application data? So one thing we're seeing in the mortgage data here is all this, boom, housing's going boom, 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 right? Builders, we're going to build like crazy. We see lots of demand. And what did we see in the survey data? Consumers saying, we're not interested in buying. Not entirely true to some degree, but let's look at the mortgage data. We see the weekly numbers drop, applications drop 4%, but look at the purchase applications. They're falling. So if people are not applying for as many purchase applications, what does that tell you about what builders are thinking is coming? It's not going to happen. There may be too much inventory in the housing market at some point. How about the refinance market? Why is this important? Because consumers pull money out of their homes and sometimes they spend it. I mean, that's, some people do refi to bring their payment down. They don't cash out money, but it's not uncommon for people to pull equity out, maybe do some upgrades or buy things. It happens. Maybe something you've experienced, but refinance applications trending down. So this is not a good sign when you're looking for credit growth, because one of the key things, and this is something we look at every Friday, is credit growth. In a debt-based economy, you need to see credit growth. And if QE is going to work and drive interest rates down, you need to see that being met with credit growth. So far, we're seeing the trend go the other direction. Let's continue on. We have then into the U.S. data. Let's see, nothing of real interest that I want to go over that day. And let's move into late Wednesday. We see Japanese foreign bond buying drop by a trillion, not a big deal because they're still on net buying. How about the services PMI in Japan contracted at a faster rate? So showing the services sector in Japan is shrinking, not something you want to see in terms of around the world. You want to see things get better. We've got the services PMI that obviously went down. And into Thursday's data now, let's take a look at the challenger job cuts. And what do you see here? They're about normalizing now. This is a good sign. So they're normalizing around 20 to 25,000 a month. That's a good sign. How about the ADP non-farm payroll change? This thing you can't even look at anymore. It used to be reasonably correlated with the non-farm payroll. Total miss on this. Let's look at the initial jobless claims that came in down to 385,000. That's a good direction that we're headed. But the seasonally and non-seasonally adjusted went up a little bit. So this a little fudging by the BLS could be a good sign, though. Going into today's payroll report is you see 366,000 drop off the total pandemic claim number to 15,400,000. Still too many people. We'll talk about that here in a little bit. And let's go into the ISM services PMI, the official. And I say official in air quotes because it's not a government statistics, but the market considers it the official gold standard. Went up from 64.7 to 70.4, showing the services sector in the United States expanded at a faster rate. And this is, I believe, the all-time high in the services PMI. But you'll notice the market really didn't care too much about this, even though you see new orders are up, business activity is up, supplier deliveries are up, employment up at a slower rate than the month before. Still expanding, but not as fast. Prices paid were up. Why? Because the services sector lags the manufacturing sector. The wages aren't generally as high in the services sector. So the market doesn't care as much because this was largely expected. Let's continue on. We had some crude oil numbers. These are actually pretty good, even though inventories beat expectations, dropped 5 million. And I can say this is good, even though distilled stocks were up 3.7 million, even though gas inventories are up 1.5. Why? Because they're below their kind of 3 to 5 year averages. This only becomes a problem if these numbers stay up and we see demand going away, which you have to be thinking about this demand component, because what's coming that we need to talk about in a show soon is people are going to start losing their pandemic unemployment assistance. So incomes are going to go down. We know as people go back to work, their wages aren't as high as they were. What will happen to demand going into the summer? That's a big question, because a lot of these people have been off work for a long time. Now, during the summer, where you'd think people would want to go on vacation and spend money, they're going to have to go look for a job. And then they're going to make less than they were on unemployment in most cases. So what will we see demand with crude oil or gas demand and distilled demand will be critical going forward. But we can see some of these numbers, a couple weeks in a row rise. But if it becomes a trend, well, now you've got a problem. Let's go into today's data, which I'm pretty interested in. The non-farm payroll board missed expectations of 650,000, came in at 559,000 for May. And that's not the problem. Remember, there's something really bad here that no one's looking at that I want to show you. We'll get to that in a moment. But let's look at average hourly earnings are up 0.5%. So those who are working are making more money. And part of the reason they're doing that, well, their weekly hours are pretty high. Now, normally, if you look at weekly hours, they tend to trend pretty solidly at around 34.5 or 34.4 hours. So wages are up. Why? Because people are working a little bit more hours. Employers saying they can't find workers, so they are having their existing workforce put in a little bit more hours, and that could help boost hourly earnings a little bit. Now, the kind of the weird part about this, the unemployment rate went down to 5.8%. A lot of people don't believe that number. The total U6 went to down to 10.2%. But what's the real story here? And the real story is the participation rate, which fell. This is not what you want to see. It fell to 61.6%. Now, what is the participation rate? It's those who, the total of the available workforce, who is age eligible, can work, who are either employed or out seeking a job. And the direction you want this number to go is pretty obvious when you're in a recovery. You'll want it to go up. Because if it's going up, what does that tell you? People are finding work, and as those people find work, their friends and family members who are unemployed are like, hey, they're getting a job, so I'll start looking for a job again. And when you get those two things going on, labor force participation rate goes up. So when it's going down, what does it tell you? People are leaving the workforce. They don't have as much confidence. But this is where QE comes into play. Now I want to show you this chart. It's a labor force participation rate in blue, and I've inverted the monetary base. Why did I invert the monetary base? Because this is what the quantitative easing does. It causes the monetary base to go up. And as you've heard in some of my interviews recently on Macro Voices and with on Blockworks.io, we talked about how the system works and how it traps dollars into the commercial banking system and tightens financial conditions. So if you want to see this, and this is a chart that no one's looking at. No one's looking at this at all. But if you look at the monetary base against the labor force participation rate, what is it telling you? It's telling you as people go back to work, there aren't going to be as many jobs as everyone claims there are. And part of the reason is there isn't going to be enough money, right? I mean, we just talked about people are going to go back to work and have less money. And it's during the summer when you'd want to go and spend some of the money you've got traveling, not doing that. So what you're seeing is the Fed is tightening financial conditions. The economy hasn't quite figured it out yet. But what I think is going to happen here, if this chart is true, now, I mean, if you want to talk about all the chips on the table, you want to look at the macro thesis, you want to see the end game, you're seeing in this chart right here how this plays out. If this chart is right, what it's telling you is people are going to start to go back to work. Some of those people, or some of the people looking for work, are going to get jobs. The rest of them aren't. And then people are going to get disenfranchised and leave the workforce. And how could that happen? Well, we just looked at the PUA claim. There's 15.4 million people. I mean, as of right now, so you got 15.4 million people on unemployment. We have recovered 65.9% of the jobs. So we still got a ways to go. And we're 11 million short. If you look at all the jobs that should have been created during this time, we're 11 million short. So if all 11 million get filled, well, you still got people on unemployment. And maybe you have people that left the job market that would want to come back but can't. And if people stop looking for work, well, then the labor force participation rate goes down and financial conditions start to get worse. And what does that tell you in terms of equity prices? Yeah, they're going to go down. What does it tell you in terms of commodity prices? They're going to go down because there won't be the demand. People will not have the incomes because they're going to lose that $300 a week benefit at some point. If not in the next couple of months, which we'll look at, I think they lose it sometime in September. And what does this mean for the bond market? How is it that I can be so insanely bullish bonds when almost everyone thinks that I am completely wrong? Because it's the same story. You take the monetary base, invert it against 30-year Treasury yields, you can see the financial tightening caused by the Fed. And then that means, what has to happen here? Interest rates have to go down, right? Why? Because you need to spur credit growth. Well, we just looked at mortgage applications. You don't see people lining up to do that. And now let's look at the banking credit data. Because that's why we look at this every Friday, is want to find out, are rates low enough to spur credit growth? Because if they're not, the rates got to go down. Bond prices go up. That's what this crown's all about. And if they keep going down and financial conditions tighten, which is how this game works, that means there's even less lending, and that means lower rates. That means rates have to go really low. The government has to step in and do something to spur lending demand. So let's look at the bank credit data and see if rates are actually doing anything. Are they actually helping the economy? Well, look at bank credit, went up $19 billion. You go, well, that's pretty good. Now, normally it is pretty good, but securities in bank credit went up $22 billion. Oh, banks are buying bonds instead of lending. How about mortgage-backed securities up $3 billion? How about treasuries that everyone says no one wants to own? Banks bought $19 billion last week. How about loans and leases? All commercial banks down $2 billion. Commercial industrial loans down $6 billion. Real estate loans down $3 billion. So you're seeing no credit growth at these current rates. It tells you they're too high. The only thing that's happening here is consumers, their credit growth went up $5 billion. And even though they're saying it's a terrible time to buy cars, automobile loans went up. So I'm kind of wondering when those two things will reconcile. And cash assets at banks fell $11 billion. So what you can see is, this issue of the Fed, unwinding this emergency facility could come at a time when liquidity dries up. And the reason we know this, and we'll look more on this on the Sunday night chart show, is what happened in the bond market today is 30-year yields broke support. And that sent, now this doesn't update all the way into close, sent 30-year treasury yields probably down to around 2.25%. And here you can see, as we covered in the show yesterday on Wyckoff method on TLT, boom, this thing looks like it's going to make another move higher. It'll get rejected and then off into the bull market. And that tells you financial conditions are tightening, tells you labor force participation can go down. And that is bad news for the economy, tells you the whole thing comes spinning apart and the equity market doesn't see it coming. But now you do. Anyways, thanks for being fans. Thanks for supporting the show as always. And I will see you, for those of you who enjoy the Sunday chart show, I will see you then. If not, I'll see you back on Monday for the macro show. I'm Steve Van Metre. Have a great weekend. Bye now. The content of this video provides educational information only, is not intended to provide investment or other advice. It does not have to be construed as recognition or solicitation to buy or sell a security, financial instrument, or participate in any particular trading strategies. It was prepared by Steven Van Metre. Personal capacity, opinions expressed in this video that do not reflect the Atlas Financial Advice Inc. or Steven Van Metre Financial.